Welcome, welcome, welcome to another day with Moonshot. Now check it out. All this is not financial professional advice, but it is advice. Now check it out. I'm gonna have to tell you something. The market been up, down, and down, and down, and down. Semiconductors getting destructed. SpaceX shot down to the ground. Now, I recently suffered some losses, 5, 6K in about 3, 4 days. And I said, well, the banks must be getting hit. But with all that money in hedge funds, there's gotta be a way to protect yourself. And I was right. It's called hedging. So let's talk about it. So, you wanna make money on earnings, but you always don't know where it's gonna go. For example, Intel. Yes, you could always put a straddle, but let's work out the problems with the straddle. For one, you have to buy with implied volatility that's up. If the stock has better than expected, but not really no big news, you get an IV crush instantly the day after, which hinders your profit. Not only does it hinder your profit, but what if the expected move is under what you expected? Not only did you pay more for the straddle, but now you're out a couple dollars. Let me tell you how the big boys play it. Okay, so what do? They buy 100 shares. 100 shares of Intel. Yes, you're talking about 10,000. But check this out. If it does really good, let's say $10, $15 move in a couple minutes. The next day, $20 move. Made some money. Made a little bit over $2,000, right? Now check this out. The put for the day following, right, doesn't cost that much. It costs a lot less. And the implied volatility is high. And so is what? The delta. Because it's so close. So check this out. You have 100 shares. The stock plummets. You're cashing in. The stock does good. You're cashing in. You won't cash in that much, but you'll have enough of profit for yourself and to cover the put. Right? Now check this out. It crashes 15%. Now you made more than the loss. Or a little bit more. So check this out. You could either sell the Intel, it's a great company, at a loss and collect the premium on the put, and the difference, you get to keep it, right? And you were in just in case. Or you take your winnings and you drop it into Intel, get that dollar cost average down, and keep the premium for yourself. Look at that. Or you have two portfolios. One has high growth, semiconductors. AMAT, we're talking about AMAT. We're talking about Caterpillar. We're talking about NBIS. We're talking about AAOI, SanDisk, Micron. We're talking about Western Digital, Seagate, 20, 30% movers. Right? Like I caught like that the other day. But when you have a semiconductor crush day, you're looking at heavy losses. ARM, Marvell, down 50%, 40%, 20%. SanDisk came down from 24 to 13. Imagine you have 20 shares, 30 shares of that. Now you gotta settle at a loss. But what if you covered yourself? What if you're in a volatile market and you say, you know what, for this week, I'm going to buy all these stocks. But on the other end, I'm going to set puts on the QQQ. You have a couple great days, you might be able to, the week like this week starts off great. Boom. Sell them at a profit. Keep the put. Thursday, Friday comes around. Boom! Collect on both ends. But sometimes a week, Sunday looks good. You wake up Monday, it's red. And I'm not talking about a little red. You know what 10% of SanDisk is. You're talking about $300, $400, 15%, you know. Now, you're looking at a 5% to 10% portfolio drop. ARM, I think it went from like 380 to 190 or something like that. You're talking about 100% moves. Imagine you got 30 shares of that. Just 10 shares, just 3 shares, 4 shares, $400 or $500. Then you combine it with 5 or 6 of these high beta stocks. You're looking at trouble. But wait a minute, you hedged. You had QQQ on a put. How about you open 2? Poof! You wake up, the market deep red. And you don't get sad. You don't get mad. As a matter of fact, you're happy. You're like, I'm down what? 10, 50%? Oh man, QQQ must be gone. And when you look, you covered. You covered. Not only did you make all your losses up, but you got profit. Now you can start dropping some positions or wait for them just to come back. What I would do is what I did. Things like ARM, Marvell, CoreWeave, cut. Why, you say? Supremely high beta, right? They also have no cash flow, and they have high debt, and they have margin pressure. And with things escalating in the US, inflation and production and distribution is becoming an issue. So guys, hedge.